Thank you, Bruce, and welcome to all of you, and thanks for coming tonight. We should have a very interesting evening before us. We are fortunate to have with us tonight one of the legendary figures of American finance. Jack Bogle founded the Vanguard Group in 1974 as a completely different kind of mutual fund company that challenged the establishment by changing the business model and offering a very different sort of company. I will leave it to Mr. Bogle to explain to you exactly why and how it is different, because that's an integral part of what he wants to tell you. But just let me say that he has been a maverick and a contrarian and has been speaking truth to power for 35 years, and we welcome people like that. He is also a prolific writer. He has just published his 7th book called Enough, which was just published in November 2008. I see a copy of it right here. And
like
there
that.
may be a few hanging around at the reception afterwards, which will follow in the Hepburn Lounge when we are through tonight. Fortune designated him as one of the investment industry's 4 giants of the 20th century. And then in 2004, Time magazine named him as one of the world's 100 most powerful and influential people. So it is a great privilege to have him with us tonight. I will look forward to what he has to say. He'll speak for about 45 minutes. Then we'll come around in front here and I will ask him a couple of questions and then open up the floor to your questions. So please join me in welcoming Jack Bogle.
Thank you, sir. Thank you so much, Dr. Bime, for that wonderful introduction. It's great to be here in Columbia, even for a guy who went to Princeton. And it's fun to explore this topic with all of you tonight. I'm a little bit envious of many of you in the room. I do not have a PhD. I am not a Rhodes Scholar. And I do not even have an MBA. And as many people have observed, it's amazing what I might have made of my life if I had had all those things. So I salute you all for your diligence in going on to higher education. It's more important today than it's ever been before. And it was a privilege, really, for me to be able to meet you and talk to you tonight. I think it's fair to say that this evening we meet at a time of financial and economic crisis in our nation and around the globe. And I would venture to assert to you that when the history of the financial era, which has just drawn to a close, comes to be written, most of its mistakes and major faults will be ascribed to the failure to observe the fiduciary principle, a precept as old as Holy Writ, that no man can serve 2 masters. No thinking man can believe that an economy built upon a business foundation can permanently endure without the same loyalty to that principle. The separation of ownership from management, the development of corporate structures so as to vest in small groups, control over the resources of great numbers of small and uninformed investors, make imperative, I think, a fresh and active devotion to that principle if the modern world of business is to perform its proper function. Yet those who nominally serve as trustees but are relieved by clever legal devices from the obligation to protect those whose interests they purport to represent, corporate officers and directors who award themselves huge bonuses from corporate funds without the assent or even the knowledge of their stockholders, financial institutions, which in the infinite variety of their operations consider only last, if at all, the interest of those whose funds they command, suggest how far we have ignored the necessary implications of that principle. The loss and suffering, you know all about this, inflicted on individuals, the harm done to a social order founded upon business and dependent upon its integrity, are incalculable. You probably have already figured out I didn't write any of that. Those words, except for the very first sentence, were the words of Harlan Fiske Stone, excerpted from an address he gave at the University of Michigan in 1934. Reprinted in the Harvard Law Review later that year. But his words are equally relevant, perhaps even more relevant on this very day. For they could hardly present a more appropriate analysis of the causes of the present-day collapse in our financial markets and the economic crisis that we are now facing in our nation and in the world. You could react to Justice Stone's words by falling back on the ancient aphorism, the more things change, the more they remain the same, and move on to another subject. But I hope you will react differently. I hope you will react the way I do. In the aftermath of the Great Depression and the stock market crash that accompanied it, we failed to take advantage of the opportunity then. And when Justice Stone was speaking to demand that our giant businesses and financial organizations, the trustees of so much of this nation's wealth, measure up to the stern and unyielding principles of fiduciary duty described by Justice Stone. So now, for God's sake, 75 years later, let's not make the same mistake again. Given this history and given this topic, it is unbelievably fitting. When I discovered this about a week ago when I started to work on this, I yelled from my office, whoopee. It's a particular fitting that I present these remarks at Columbia University. For Harlan Fiske Stone ranks among Columbia's most distinguished sons. He received his law degree at Columbia here in 1898 and returned to serve as dean of the Columbia Law School from 1910 to 1923. In 1924, he was appointed as Attorney General by President Calvin Coolidge, and in 1925, Coolidge appointed him Associate Justice of the United States Supreme Court. In 1941, President Roosevelt appointed him Chief Justice of the United States, and when he died in 1946, after 21 years of service to the court and the nation, he left a remarkable legacy of accomplishments, of judicial philosophy, and of worldly wisdom. It seems particularly fitting then, I think, to discuss Justice Stone's philosophy and his remarkably prescient warning about the abject failure of our corporate and financial institutions that we have witnessed during the recent era, so remarkably similar to those of 3 generations earlier. It's even more fitting, I think, to discuss these issues at the annual KPMG Pete Marwick and Stanley R. Klein Forum for 2009, part of Columbia's effort to encourage greater awareness of the ethical dilemmas faced by today's business and financial leaders. Included among these leaders are the chiefs who manage our publicly held corporations, today valued in the stock market at something like $10 trillion, maybe that was yesterday, and the professional managers of other people's money who now oversee equity investments valued at something like $7 trillion of that total, owning 70% of all shares, and therefore having absolute voting control over these corporations. Like their counterparts in business, these powerful managers have not only an ethical responsibility, but a fiduciary duty to those whose capital has been entrusted to their care. The concept of fiduciary duty has a long history, going back 8 centuries or so to English common law, essentially a legal relationship of confidence or trust between 2 or more parties, most commonly a fiduciary or a trustee or a principal or a beneficiary who justifiably reposes confidence in good faith and reliance on his trustee. The fiduciary, classically, acts at all times for the sole benefit and interest of another, with loyalty to those interests. A fiduciary must not put personal interest before that duty, and most importantly, I'll come back to this later in my remarks, must not never be placed in a situation where his fiduciary duty to clients conflicts with a fiduciary duty to any other party. That's basic Hornbook fiduciary law. Way back in 1928, New York's Chief Justice Benjamin N. Cardozo put it well. I'm sure some of you are familiar with him. Many forms of conduct permissible in a workaday world for those acting at arm's length are forbidden to those bound by fiduciary ties. A trustee is held to something higher, stricter than the morals of the marketplace. As to this, there has developed a tradition that is unbending and inveterate. Not honesty alone, but the punctilio of an honor most sensitive is then the standard of behavior. Only thus has the level of conduct for fiduciaries been kept at a higher level than that trodden by the crowd. It has been said, I think accurately, that fiduciary duty is the highest duty known to the law. It is less ironic than it is tragic that the concept of fiduciary duty seems far less embedded in our society today than when Stone and Cardozo expressed their opinions all those years ago. As ought to be obvious to all educated citizens, over the past few decades, the balance between ethics and law on the one hand and the markets on the other have heavily shifted in favor of the markets. As I've often put it, we have moved from a society where there are some things one simply did not do to one in which, if everyone else is doing it, I can do it too. I describe this change, I think accurately, as a shift from moral absolutism to moral relativism. Business ethics, it seems to me, has been a major casualty of that shift in our societal values, and you will hardly be surprised to learn that I do not believe that change is progress. At least a few others share this view. In her 2006 book, Trust and Honesty, Boston University Law School professor Tamar Frankel provides worthy insights into the diminishing role of fiduciary duty in our society. She is concerned, a concern I think many of you probably would share here tonight, that American culture has been moving toward dishonesty, toward deception, and abuse of trust, all of which have come to fore in the present crisis. What we need, she argues, is an effective way to increase trust by establishing trustworthy institutions and reliable systems, even as she despairs the pressures brought out by the stock market and real estate bubbles that led to deteriorating public morals and burst into abuses of trust. In Professor Frankel's view, we reduced the power of, I'm quoting here, of morality in law, emasculated the regulation of trusted persons, that is fiduciaries, abused the laws that govern fiduciaries' honesty, and opened the door to enormous losses to the public and in the economic system. We also came to ignore a subtle but critical distinction between fiduciary law itself and a fiduciary relationship that is merely subject to contract law. They're different things. What's more, she writes, the movement from professions to businesses was accompanied by changes in the way the law was interpreted for the worst. We forgot that fundamental principle expressed by, I think, both Matthew and Luke, and repeated by Justice Stone, that no man can serve two masters. My principal objection to moral relativism is that it obfuscates and mitigates the obligations that we owe to society and shifts the focus to the benefits accruing to the individual. Self-interest, unchecked, is a powerful force. You all know that. I'm sure you taught that. But a force that, if it is to protect the interest of the community of all of our citizens, needs ultimately to be checked by society. The recent crisis, which has been called, I think rather cleverly, a crisis of ethic proportions, nice, huh? Makes it clear how serious that damage can become. The causes of that crisis are obviously manifold. Metaphorically speaking, the collapse in the financial system has 1,000 fathers. No, I will not give you all of them. But I would include the cavalier attitude toward risk of our bankers and investment bankers, holding a toxic mix of low-quality securities on unbelievably enormously leveraged balance sheets. The laissez-faire attitude of our federal regulations reflected in their faith that free competitive markets would protect our society against excesses. The Congress, I might even call it our wonderful Congress, which rolled back legislative reforms going back to the Depression years, such as Glass-Steagall. Securitization, in which the traditional and an essential link between borrower and lender, under which lenders demanded evidence of borrower's ability to meet their financial obligations, was severed. Reckless financial innovation, which literally tens of trillions of dollars of derivative financial instruments were created, credit default swaps, for example, usually carrying stupefying levels of risk and unfathomable levels of complexity. This radical increase in power and position, or the radical increase in the power and position of the leaders of corporate America, I won't try and distinguish them tonight as I can, and the leaders of investment America, that's the distinction, corporate and investment, has been a major contributor to these failures. Today's dominant institutional ownership position of 70% as I mentioned, of the shares of our giant public corporations compares with only about 8% 50 years ago, half century ago, from 8 to 70%. This remarkable sea change in ownership has placed these managers largely at mutual funds, who own 25% position, and pension funds, 20% position of that 70. Hedge funds and endowment funds, smaller positions, in a position to exercise great power and influence over corporate America. But they have not exercised it. In fact, the agents of investment America have failed to honor the responsibilities that they owe to their principals, those last line individuals who have their capital wealth committed to the stock market, including mutual fund share owners, obviously, and pension beneficiaries. The record is clear that despite their controlling positions, most institutions have failed to play an active role in board structure and governance, in director elections, in executive compensation, in stock options, in proxy proposals, in dividend policy, and so on. Given their forbearance as corporate citizens, these managers arguably played a major role in allowing the managers of our public corporations to exploit the advantages of their own agency, not only in exec comp, perquisites, mergers and acquisitions, but even in accepting the financial engineering that has come to permeate corporate financial statements, endorsed at least tacitly, and I think for the worst, very much for the worst, by their presumably independent, otherwise independent public accountants. I think there's a big part of the failure there. But the failures of our institutional investors go beyond governance issues to the very practice of their own trade. These agents have also failed to provide the due diligence, and people have not made this point. I don't think, I've never actually seen anybody else say this, but it seems to me so obvious, that our citizens and these agents have failed to provide the due diligence that our citizens, investors, have every reason to expect of the investment professionals to whom they have entrusted their money. How could so many highly skilled, highly paid security analysts and researchers have failed to question the toxic-filled leveraged balance sheets of Citicorp and other bleeding banks and investment banks, and for that matter, of AIG? The ethics skirting sales tactics of Countrywide Financial. Even earlier, what were these professionals thinking when they ignored the shenanigans of those special purpose entities at Enron and all the cooking of the books that was going on down at WorldCom? Again, going back to the stock market high reached in 2007, how many analysts took the trouble to question the typical corporate assumption, not very long ago, that their pension funds would earn future returns of 8.5% a year, now obviously a deeply flawed assumption that is sowing the seeds of, I am sorry to tell you all, you will see it in the crisis in the financing of our private and public retirement systems. I wish I had some good news. But the failure of our newly empowered agents to exercise the responsibility of ownership is but part of the problem we face. The field of institutional management, the field in which I spent 58 years of my own life, often also played a major, if often overlooked, role. As a group, we in this trade veered off course almost 180 degrees from stewardship to salesmanship, in which our focus turned away from prudent management and toward product marketing. Not a good turn. We moved from a focus on long-term investment to a focus on short-term speculation. Look at the data. The driving dream of our advisor agents was to gather ever-increasing assets under management, the better to build their advisory fees and profits, even as these policies came at the direct expense of the investor principals, whom under traditional standards of fiduciary duty and trusteeship, they were duty-bound to serve. Conflicts of interest are pervasive throughout the entire field of money management, albeit different in each sector. For example, private pension plans face one set of conflicts. Minimizing plan contributions help to bump your earnings. Public pensions, another kind of pressure, often the political pressure to invest in pet projects of the legislators. Labor union plans, another conflict, different kind of a conflict, the pressure to employ money managers who are willing to pay to play. But it is in the mutual fund industry where the conflict between fiduciary duty to fund shareholder clients often directly conflicts with the business interests of the managers. Perhaps we shouldn't be surprised this is the case, that money managers act first in their own behalf. Indeed, as Vice Chancellor Leo Strine of the Delaware Court of Chancery has observed, it would be passing strange if professional money managers would, as a class, be less likely to exploit their agency than the managers of the corporations that make products and deliver services. In the fund industry, by far the largest of all these financial intermediaries, that failure to serve the interest of fund shareholders has wide ramifications. Ironically, the failure has occurred despite the clear language, it couldn't be clearer, of the Investment Company Act of 1940 that says mutual funds should be managed and operated in the best interest of their shareholders rather than in the interest of their advisors. How did this happen? Well, in summary form, here are just a few examples of how far we in the fund industry, or some in the fund industry, have departed, many in the fund industry have departed from that basic fiduciary, those basic fiduciary principles that are so clearly enunciated in the 40 Act. One, the domination of fund boards by chairmen and chief executives who also serve as chairman and chief executives of the management companies that control the funds. It's easy at contract setting time. Warren Buffett has the wonderful saying, about negotiating with yourself, it's simply not. I guess the expression is, negotiating with oneself rarely produces a barroom brawl, I think is the sentence. 2, mutual fund time zone trading. Those disgusting scandals that came to light in 2003 in which some 23 mutual fund companies, including some of the largest, very largest companies in the entire business, got caught in allowing their own employees and other people to trade against time zones and against the interest of their own shareholders. We also have rising management fees. Fund assets have soared in this period, and even despite that soaring assets, management fees, dollar management fees, have soared at an even higher rate, and therefore expense ratios have risen. Just consider, for example, the average, some of the old funds, largest 10 funds back in 1960, their average fee rate has grown from approximately, I think the number is about 60 to 108 average expense ratio in that period. It's actually more than that because of an increase of more than 100% in the fee rate, despite this huge increase in fund assets, and the economies of scale simply have not been provided to fund shareholders. Another problem, many fund managers are also pension managers. In fact, just about all mutual fund managers are running pension funds, to the point you can't really distinguish the two industries any longer. But they charge far lower expenses and fee rates to their pension clients than they do to their mutual fund clients. Specifically, mutual fund managers charge 8 basis points to their private pension clients and 61 basis points to their comparable funds. But since the comparable funds are so much better, the annual fees from the pension plans average $600,000 in one study compared to 56 per year, $600,000 a year for the pension account, $56 million a year for the mutual funds, presumably for holding the exact same portfolios or very close to the exact. What's more, funds spend an enormous amount on advertising to bring in new fund investors with money directly obtained from existing fund shareholders. And finally, not really finally, but the last example I have here is our industry has created exotic and untested fund products that have more ephemeral marketing appeal than investment integrity. And you see them advertised in the paper every day. Like, given such failures as these, doesn't Judge Stone's warning that I cited at the outset seem even more prescient? Think about it: the separation of ownership from management, corporate structures that vest in small groups control the resources of great numbers of small and uninformed investors, corporate officers and directors who award to themselves huge bonuses, financial institutions which consider only last, if at all, the interest of those whose funds they command. Just as we ignored the fiduciary principles all those years ago, so we have clearly continued to ignore it in the recent era. The result in both cases, again using Justice Stone's words, the loss and suffering inflicted on individuals, the harm done to a social order founded upon business and dependent upon its integrity, are incalculable. And the only argument I have in the current environment, we can in fact calculate it. And we can calculate it as something in the trillions of dollars already. So this time around, we've been warned. It's happened again. Let's pay attention and demand a return to fiduciary principles by our money managers. While the overwhelming majority of financial institutions operate primarily in the interests of their agents and the experience of their principals, not quite all do so. So I now, this is the commercial part of the message, I guess, I now draw on my personal experiences in the mutual fund industry to give you one example with my own encounter with this issue. As far back as 38 years ago, I expressed profound concern about the nature and structure of the mutual fund industry. Only 3 years later, my convictions led to action, starting Vanguard. 35 years ago this September, I founded a firm designed to the best of my ability to honor the principles of fiduciary duty. I expressed these principles back in 1971 when it was distinctly counter to my own best interest. Speaking to my partners at Wellington in September 1971, I cited the very same words of Justice Stone with which I opened my remarks this evening. I then added, I endorse that view and at the same time reveal an ancient prejudice of mine. All things considered, absent a demonstration that the enterprise has substantial capital requirements that cannot be otherwise fulfilled, it is undesirable for professional enterprises to have public shareholders. The constraint is as applicable to money managers as it is to think about this as to doctors or lawyers or accountants or architects. In their cases, as in ours, Wellington Management Company, and it's hard to see what unique contributions public investors bring to the enterprise. They do not add capital, as a rule. They do not add expertise. They do not contribute to the well-being of our clients. Indeed, it is possible to envision circumstances in which the pressure for earnings and earnings growth engendered by public ownership is antithetical to the responsible operation of a professional organization. Even though the field of money management has elements of both, business and profession, there are, after all, differences. So we must ask ourselves this question. This is continuing what I was saying in 1951 to the partners of Wellington Management Company. If it is a burden to our funds and counsel clients to be served by a public enterprise, should this burden exist in perpetuity? That candor may well have played at least a supporting role when I got fired as chief executive of Wellington Management Company 3 years later. It's a saga too complex to detail this evening, but my firing gave me the chance of a lifetime, the opportunity of a lifetime to create a new fiduciary-focused structure for our funds. Lightning had struck, and it was good lightning. I proposed exactly that structure to the directors of the Wellington funds, and Wellington Management Company, my former employer, of course, vigorously opposed those efforts. Nonetheless, after months of study, the directors of the funds accepted my recommendation that we separate the activities of the funds themselves, those separate corporations with their own shareholders, from their advisor and distributor, a separate corporation with public stockholders as well as inside stockholders, so that the funds would operate solely in the interest of fund shareholders. Our new structure involved the creation of a new firm, the Vanguard Group, and the Vanguard Group of investment companies. A truly mutual fund firm was duly created. The management company was owned by the funds, employed its own officers and staff, and operated on an at-cost basis to serve shareholders. So we tried to put in place all those years ago that kind of a structure. Now, while Vanguard began with a limited mandate, we were only to provide administrative services to the fund. I realized very quickly this is a long and complex corporate struggle that we don't have time for tonight. If we control our own destiny for this firm, we should also have to provide both advisory services and marketing services as well as just being an administrator. So almost immediately after Vanguard's operations began in May of '75, we began our move to gain control over these key advisory marketing functions. By year's end, we'd created, because of this environment, another very happy thing that happened, the world's first index mutual fund run by Vanguard. Early in '77, only a few years later, we abandoned the supply-driven broker-dealer distribution system that had been operated by Wellington since 1928 in favor of a buyer-driven no-load approach under our own direction, Vanguard's own direction. Later that year, we created the first series of defined maturity bond funds, separated to short, intermediate, and long-term maturities, never been done before, and focused on high investment quality. And then in 1981, we assumed responsibility providing the investment advisory services for these fixed income funds, as well as our established money market funds. As you can imagine, none of these moves was without some controversy at the board level, which is fun if you win, with very narrow votes. Let me give you some sense of the importance of those changes. Since we were formed in 1975, the assets of Vanguard funds have grown from about $1 billion plus to $1 trillion today, even after the recent unpleasantness. And some 82% of that total, $820 billion, is represented by passively managed index funds, those bond funds, and the money market funds that we at Vanguard manage, distribute, and advise, the whole schmear. More than parenthetically, that long string of business decisions was made in a situation in which Vanguard's very existence was in doubt. We were hanging under the proverbial sword of Damocles because the SEC, in its wisdom, had refused to approve Vanguard's plan of operation. But after a struggle lasting, believe it or not, 6 interminable years under that sword. The SEC reversed itself in February 1981, and by unanimous vote, the Commission declared, after giving me gray hairs or something, as follows. The Vanguard plan is consistent with the provisions, policies, and purposes of the Investment Company Act of 1940. It actually furthers the Act's objectives, enhances the fund's independence, benefits each fund within a reasonable range of fairness, provides substantial savings from advisory fee reductions and economies of scale, and promotes a healthy and viable mutual fund complex in which each fund can better prosper. I like the words so much we put them in our annual report that year. Indeed, the SEC's words now seem prescient. Think about it. Can best prosper rather than can better prosper might have been more accurate. Measured by Morningstar's peer-based rating system, which you compare funds with their similar policies and objectives, Vanguard ranked first in performance among the 50 largest companies. Advisory fee reductions and economies of scale at the SEC cited, once again, one can only say indeed. Vanguard's low costs are legendary, by far the lowest in the field. Last year, overall operating expense ratios averaged 0.20 of assets, 20 basis points, compared to 130 basis points for the average mutual fund. That 1.1 percentage point saving applied to $1 trillion asset base gave our shareholders $11 billion of savings in that 1 year. Do low costs matter? Of course they do. I'm sure you've learned that here. As the world of investing is at last beginning to understand, low costs are the single most reliable indicator of superior fund performance. Yes, as we read in Homer's Odyssey, I thought we might as well get a little classics in here, fair dealing yields more profit in the end, and it does. Good ethics is good business. If you're willing to accept, based on that really solid data, that Vanguard has achieved both commercial success, asset growth and market share, and what I call artistic success, superior performance and low cost, you must wonder why, after 35 years of existence, that no other fund has ever had elected to emulate our shareholder-oriented structure. A particularly ironic outcome, since I chose the name Vanguard for the firm because of its conventional definition as the leader in a new trend. The answer, I think, can be expressed succinctly, why they haven't. Because under our at-cost structure, all of the darn profits go to the fund shareholders, not to the managers, resolving the transcendent conflict of interest in the mutual fund industry. In any event, the leader, as it were, has yet to find its first follower. Vanguard represented my best effort, an imperfect effort, but my best effort to align the interests of fund investors and fund managers under established principles of fiduciary duty. I leave it to far wiser heads than mine, and certainly more objective heads than mine, to evaluate whether I overstate or hyperbolize what we've been able to accomplish, even as I freely acknowledge that we owe these whatever we have accomplished to 3 simple principles. Number 1, the firm is structurally correct. We are owned by our fund investors. Number 2, the firm is mathematically correct, since it's a tautology that the lower the costs incurred in investing, the higher the returns. Check anywhere to find that out. And number 3, I believe, ethically correct, since we exist only by earning the trust and loyalty of our shareholders. And we do so much better than that of our peers, it's quite unbelievable. There's simply no rival to our standing with when they do loyalty studies. So be skeptical, appropriately skeptical, of my self-serving claim here, but the most recent survey, we don't do these surveys ourselves, somebody else does them. I don't think we even buy them, I think we steal them because we're rather cheap. But in 2007, an independent research group concluded Vanguard generates far more loyalty than any other company. And it's off the wall. We're like a plus 45 or 50 on some kind of a scale, where the average mutual fund is minus 12. Talk about an industry with some problems, and you got a minus 12 trust rating. In any event, as you've learned, restructuring the firm was no easy task. With that determination, which is one asset I do have, the only one I'd claim, expertise, luck, timing, and key roles played by just a handful of individuals, Vanguard never would have happened. So when I suggest to this forum that we must now go beyond restructuring the nature and values of a single firm, to restructuring the nature and values of the entire money management industry, I am well aware of how difficult it will be to accomplish that sweeping task. And yet we dare not stand still. For we meet at a time when, as never before in the history of the country, our most cherished ideals and traditions are being subjected to searching criticism. The towering edifice of business and industry, which has become the dominating feature of the American social structure, has been shaken to its foundations by forces the full significance of which we can still see but dimly. What had seemed the impregnable fortress of a boasted civilization that has developed unsuspected weaknesses, and in consequence, we are now engaged in the altogether wholesome task of critical re-examination of what our hands have reared. Well, you figured it out, I'm sure. Those last comments were from Justice Stone in his 1934 address. I don't write my own stuff anymore, I just rely on him. But it's high time we take it seriously. For the fact is, there has been a radical change in our investment system from the ownership society of a half century ago, which is gone and it will never return, to our agency society today, in which our agents have failed to serve their principals, those fund shareholders and beneficiaries and long-term investors. Rather, the new system has served the agents themselves. Those examples make that clear, our institutional managers. Further, by their forbearance, these money managers have also served the managers of corporate America. To make matters even worse, by turning to short-term speculation at the expense of long-term investing, the money management business also damaged the interest of the greater society. How bad is the damage? Hear John Maynard Keynes on this subject. When enterprise becomes a mere bubble on a whirlpool of speculation, the consequences may be dire. When the capital development of a country becomes a byproduct of the activities of a casino, the job of capitalism will be ill done, and it is being ill done. Yet despite these changes in the very nature of corporate ownership, we have failed to change the rules of the game. We've had this enormous change, and nothing has changed to deal with the new world. Indeed, in the financial sector, as I mentioned earlier, we've rolled back most of the historic rules regulating our securities issuers, our exchanges, and our investment advisors. While we should have been improving regulatory oversight and administering existing regulations with increasing toughness, these regulations have been relaxed, ignoring the new environment, and therefore bearing itself even more of the responsibility for today's crisis. Of course, American society is in a constant state of flux. It always has been, and it always will be. I pointed out in some of my recent writings that our nation began as, and you all know this, began as an agricultural economy, and then became largely a manufacturing economy, and then largely a service economy, and most recently an economy in which financial services sector has become the dominant element. Such secular changes are not new, but they are very difficult to deal with, and they're always different, and so enlightened responses are not easy to come by. Justice Stone, once again, this time I'm telling you first, recognized how new forces shaped new responses. Here's Justice Stone speaking. It was in 1809 when Jefferson wrote, "We are a rural, think about this, we are a rural farming people. We have little business and few manufacturers among us, and I pray God it will be a long time before we have much of either." Jefferson's prayers were not answered. Profound changes, Justice Stone continues, have come into American life since that sentence was penned. Those inexorable economic forces create public problems that involve an understanding of the new and complex economic forces we've created. Their relationship in the lives of individuals is in widely separated communities engaged in widely differing activities, and the adaptation to those forces of old conceptions developed in a different environment to meet different needs. So to deal with the new and complex economic forces in our failed agency system, we of course need a new paradigm, a new paradigm, a fiduciary society in which the interests of investors come first, and ethical behavior by our business and financial leaders come to represent our highest value. Now, how do we build a fiduciary society? Well, first, start with this. While the challenges of today are different, inevitably, the principles are age-old. Consider this warning from Adam Smith way back in the 18th century. The managers of other people's money rarely watch over it with the same anxious vigilance with which they watch over their own. They very easily give themselves a dispensation, and negligence and profusion must always prevail. And so in the recent era, negligence and profusion have prevailed among our money manager agents, even to the point of an almost complete disregard of their duty and responsibilities to their principals. Too few managers seem to display that anxious vigilance over other people's money that Adam Smith defined as the standard of conduct for investment professionals. So what we have to do is develop a new fiduciary society that guarantees our last line owners, those mutual fund shareholders again and pension beneficiaries whose savings are at stake, their rights as investment principals. What would those rights be? Well, I just have listing 6 of them here for you. 1, the right to have their money manager agents act solely in their behalf. The client must be king. 2, the right to rely on due diligence and high professional standards on the part of our money managers and securities analysts who appraise securities for our portfolios. 3, the right to demand some sort of discipline and integrity in the mutual funds and financial products that these agents offer. 4, the assurance that our agents will act as responsible corporate citizens, restoring to their principals the neglected rights of ownership of stocks and demanding that our corporate directors and managers meet their fiduciary duty to their own shareholders. 5, the establishment of advisory fee structures that meet a reasonableness standard based not only on rates, but on dollar amounts and their relationship to the fees and structures available to other clients of the same manager. And 6, the elimination of all conflicts of interest that could preclude the achievement of those goals. More than parenthetically, I note here that the final provision, elimination of conflicts of interest, would seem to preclude, think about this for a minute, the ownership of money management firms by financial conglomerates, now the dominant form of organization in the fund industry. Once you can't be a fiduciary to some big financial conglomerate that owns a mutual fund management company, and also a fiduciary to the shareholders of that mutual fund. It's a conflict of interest. But think about this. Among today's 40 largest fund complexes, only 6 remain privately held. The remaining 34 includes 8 firms whose shares are held directly by the public, and an astonishing total of 36 fund managers owned and controlled by U.S. and international financial conglomerates, including Goldman Sachs, Bank of America, Deutsche Bank, ING, John Hancock, Sun Life of Canada, and so on down the line. Painful as such a separation might be, it is the single most blatant violation of the principle that no man can serve 2 masters. Of course it will take federal government action to foster the creation of the new fiduciary society that I envision. Above all else, it must be unmistakable that the government intends and is capable of enforcing standards of trusteeship and fiduciary duty under which money managers operate with the sole purpose and in the exclusive benefit of the interest of their beneficiaries, largely those fund share owners and pension plan beneficiaries. While government action is essential, however, and I'm not a big believer in big government, the new system, I think, can be developed in concert with the private investment sector, a sort of Alexander Hamilton-like, might as well get to a nice Columbia graduate, sharing of the responsibilities. The task of returning capitalism to its ultimate owners will take time, true enough. But the new reality, increasingly visible, I think, with each passing day, is the concept of fiduciary duty is no longer merely an ideal to be debated, is a necessity to be practiced. So lots at stake in reforming the very nature of our financial system itself, which in turn is designed, I hope you didn't miss this point, to force reform in our failed system of governance of our business corporations. What I'm passionately advocating in these remarks is hardly widely shared among my colleagues and peers. As a matter of fact, they don't like it. But soon, perhaps many others will ultimately see the light. Only last week, the idea of governance reform, for example, got very encouraging support from Professor Andrew W. Lowe of MIT, Andy Lowe, one of today's most respected financial economists. Here's what Andy Lowe said. The single most important implication of the financial crisis is about the current state of corporate governance. Right on, Andrew. A major wake-up call, he continues, that we need to change the rules. There's something fundamentally wrong with current corporate governance structures and the kind of risks that typical corporations face today, end of quote. In sum, the changes in the rules that I advocate, applying a federal standard of fiduciary duty to institutional money managers, and to be designed in turn to make them use their own ownership position to demand that managers and directors of the corporations whose shares they invest honor that fiduciary duty principle to holders of all of their shares. Finally, because, of course, it is these two groups that share the responsibility for the prudent stewardship over corporate assets and investment securities alike that have been entrusted to their care, not only reforming today's flawed and conflict-ridden model, but developing a new model that at best will restore traditional ethical mores. Now you got to be a little bit patient because I got a couple more quotes. So I await, very short ones, and I await with no great patience myself, by the way, the return of the standard so beautifully described earlier by Justice Cardozo all those years ago. And I'm taking just an excerpt from those earlier remarks for emphasis. Those bound by fiduciary duties are held to something stricter than the morals of the marketplace. Marketplace doesn't run things anymore, Alan. That's what I said. That's not what Cardozo said. A tradition, Alan Greenspan, obviously, a tradition unbending and inveterate, and not honesty alone, but the punctilio of honor, the most sensitive, a level of conduct higher than that trodden by the crowd. But I owe it to Judge Harlan Fiske, your fellow Columbian, to his legacy to conclude my remarks with yet one more quotation from his profound and prescient 1934 speech that has been inspiration for my remarks this evening. In seeking solutions for our, this is a very broad-gauged comment, in seeking solutions for our social and economic maladjustment, we are too ready to place reliance on the policeman's nightstick of the state may command, rather than on what may be given to it as the free offering of good citizenship. Yet we know, he continues, that under the urge to individual advantage has other curbs, and unless the more influential elements in society conduct themselves with a disposition to promote the common good, society cannot function. Especially a society which has largely measured its rewards in terms of material gains. We must square our ethical conceptions with the traditional ethics and ideals of the community at large. There is nothing more vital to our own day, that was his day, but it's this day too, that those who do act as fiduciaries in strategic positions of our business civilization should be held to those standards of scrupulous fidelity which our society has every right to demand. End of Justice Stone's quote. So, in this Columbia Leadership and Ethics Week of 2009, I'm really happy and delighted to have the opportunity to strengthen our resolve, and I hope to strengthen your resolve, that we come back and meet that test. We owe nothing less to the United States. Thank you.
First, and then I will invite you all to join the discussion with your questions as well. So, thank you very much for your remarks. It does seem that there are two themes in what you say, and let me just see if I can summarize them appropriately. That in order to avoid or deal with conflicts of interests, there are really two general approaches. One would be to appeal to people's conscience and to say that you have conflicts, many of which cannot be avoided, and therefore be aware of them, learn how to manage them, and sensitively handle them. Or the other is to sort of surgically separate things so as to make conflicts as minimal as you can get them. And I gather from your remarks that you are particularly advocating the second, although both are obviously important to you. So would you, for example, go further? Would you bring back Glass-Steagall? Would you separate investment and commercial banking? Within investment banking, would you separate origination, investment banking, from distribution, brokerage? Would you bring back those separations, which prevailed when I joined Wall Street in the 1960s?
Well, Glass-Steagall's really a good example. In my fifth book called The Battle of Soul Capitalism, I actually have a section in it called Bring Back Glass-Steagall. The tragedy is that the intermix between our commercial banks and our investment banks now is probably an omelet that can't be unscrambled, to use a sort of homey metaphor. And you know, once you break the eggs, they're broken. So I don't see how you do that. But I do think we should all realize that one of the things that obviously happened in the investment banking field, and so much has happened that we just kind of ignore it, but when these investment bankers used to be all privately held firms, and they had partners, and each partner had an unlimited liability. That's the way partnerships work. And they were kind of under control. Does anybody in the room imagine that a privately held firm with unlimited liability would have 40-to-1 leverage over a portfolio of junk? I mean, really? They wouldn't dream of it. So public ownership itself has led us in a very bad direction for much of the financial community. And public ownership of management companies, as I mentioned, is succeeded by conglomerate ownership. I mean, believe me, when Deutsche Bank buys your management company for $1 billion, they have one objective and one objective alone: to earn their cost of capital. Let me call it $150 million a year. And believe me, if you're running that firm they've acquired and you don't produce $150 million of earnings, they will get someone who will. I mean, that's the way corporate America works. And it just fails and falters when cost and value are directly linked in the financial business. I mean, it must be very clear that the big thing that has to happen here is to take cost out of the system. I'm sorry to tell you all this, but that's what has to happen. Because according to my data, something like 560 billion of the financial system, investment system, brokerage, investment banks, mutual fund managers, hedge funds, so on, are taking about 560 billion a year out of pockets of investors. And if you only understand the simple rudimentary rule, that we'll call it the casino rule, that everybody gets out there and bets, and the winners offset the losers, except they don't offset each other one-to-one. They offset less the cost of the croupier. So as long as we've got 560 billion of croupier's cost, it may work in a market where it's generating returns of 17% a year, which is what the stock market did for 20 years. But it certainly isn't certainly not going to work in the environment that we have. And trading, to take another very simple example, we have an industry. I mean, and I'm sorry to be so blunt about it. I just lost all my tactfulness some years ago. But we have an investment system that pits one investor against another. Try and beat that guy. That's what they say. Because when you buy something, somebody else sells it. It's not complicated. So the more investors act in the interest of what they're advised to do, beat the other guy, they will lose the other guy. And if you want to take it one more step, if they stop doing that and don't pay those croupiers, and they all index, of course, then they will capture at long last the market return. So by doing something economically right for themselves, they do something socially right for the community of investors at large. It's an important point. So I think some kind of separation is good, but I'm really mindful of the fact that it's very difficult for the government, I think, to decree specific rules as compared to I would call fiduciary duty a principles-based structure. We talk a lot about that in the accounting area, and it's very difficult to do. I don't make light of it. But I think I'd rather have people required to live up to principles than try and draw the rules. And one never knows, of course, who's watching The Watchmen. It's just constant, particularly in this day of the movies.
One of the structures that we do have in place in the United States that the law has embodied for United States mutual funds is the system of boards with independent directors. And you mentioned in your talk that these boards have not always been independent. Sometimes they've incorporated the management. But there's an increasing requirement now that the boards be at least 75% independent directors and that the key committees be in the independent directors. Do you think the system of independent directors, which is complex, is worth it? I mean, do independent directors, they're there to help avoid conflicts, but do they succeed in that role, or is this a waste of time and money?
Well, I would quote the great Buffett and say the mutual fund boards of directors, I mean, he says it much more strongly than this, are just a giant joke. They do nothing. They go along with whatever management recommends. He says tougher and tougher things. Take a look at one of his annual reports. You can probably Google that somewhere and find out the exact words. But the missing link, the fund should have independence boards, no question about that. It's a reasonable kind of protection. But the independent board, in my judgment, is not going to get anywhere until they have an independent chairman. And very, very few mutual fund managers are willing to ring, the heads of those fund management companies are very unwilling. And I just can't see Ned Johnson saying, come on guys, I'm through. And he's the Fidelity man, for those of you who haven't been around for a few years or something. But once we have an independent chairman, you then have a board where the agenda is set for the chairman. You then have the independent people. The independent chairman, one thing we have done is, two things we've done, which I think are pretty good. One, each fund has a chief compliance officer now, is required to have for the funds, not working for the management company, who he talks to when he's in the office. And two, an independent counsel, legal counsel, who is not the same as the legal counsel of the fund. We've been for decades for the same lawyer representing the fund and the management company. I mean, come on. So, but those two persons have no one to report to except the chairman of the management company, who's chairman of the funds. So a fund chairman would be able to provide that extra focus on kind of some sort of an organizational structure, little organization chart kind of thing. And there's also, I mean, the limits are, I mean, this industry has gotten so out of hand, not necessarily, I think in a bad way, but not necessarily in a bad way, by having so many funds that an independent director really can't possibly know what's going on. I believe Fidelity has 350 mutual funds. So you're a fiduciary as a director to 350 funds. I said, part kiddingly, but saying something that a little more serious, and making, I think, a point that was a little more serious. We also need a staff for this independent board now, an independent chairman, an independent compliance officer, an independent counsel. They need to be a small staff. Let's say some good MBAs from Columbia, who are looking over all the management company data and saying to the board, here's what this means. Because directors can only do so much when you get to 350 funds. It's absolutely hopeless. You have to have a staff to do that. And so, part kiddingly, I said this wouldn't have to apply to anybody. It would only apply to let's say, fund complexes with more than 10 funds. And you could get an exemption if the directors could name all the funds they were director of. Then you wouldn't have to apply. Well, I mean, no director could ever meet that test. And to ask them own stock in 350 funds, well, don't even think about that. And by the way, whenever you see some of these ghastly new products that we're bringing out on these very days, you see them advertised in the Wall Street Journal, you just go to the prospectus and look at one thing. How many shares do the directors own in those funds? If anybody in the class finds a single fund director who owns a single share of a single crummy new product that's been brought out by this industry, my number is 610 669 6081. Call me immediately. Okay. They're just not there. So we have to give the board a little spine, but a little girth or heft.
That you support the system.
Well, I support that as the second best choice.
Okay.
It must be clear that there have to be other vanguards developing. And I think I can tell you the story. I'm always looking for someone to pick off, because an entrepreneur, when you start de novo, an entrepreneur is not going to come into the fund business and, let's say, put up $1 million or $10 million, maybe more likely, or 20 million, and start a new fund company and get out and get fund business. Unless he can get a return, let's say he puts up 10 million, unless he can get a return of 250,000 a year, he's not going to be content with 10%. He'll probably find that somewhere else somehow. So he has to make that money. So new fund complexes aren't going to come this way. But when a complex is troubled, there may be ways when times get bad and they have bad performance and huge capital outflows and management that has disgraced the funds by totally breaching any concept of fiduciary duty, i.e. Allowed the portfolio managers of the fund to trade shares of the fund against after hours against the interest of the fund, and when they're caught, doesn't even think it's necessary for him to report these actions to his own board of directors. But you would think he could persuade the head of the independent chairman of the independent directors of that fund to take action, do something, and I would say to mutualize. And this is in fact a case that I've talked about, which is the Putnam case. And they were bought by Marsh & McLennan many, many years ago. The company was pretty much ruined under its previous president, who was making like $50 million a year, 25, I don't know how, a lot of money. and tolerated all these things going on. Their performance was right at the bottom of the deck. They happened to be last in that list of 50 funds that I mentioned, or 40 funds that I mentioned among the larger kind of last in performance. And I thought, well, my God, here's a good one, because Marsh and McLennan wanted to sell Putnam Management Company to somebody else. So I said, look, pal, he wasn't my pal, but he was the independent chairman of the funds, and I said, this is the time. This is the moment. This is an Obama moment. And to mutualize. You'll save the funds a fortune. You'll be controlling them yourself. You keep the, I like very much, by the way, the successor head of the management company, a person of very high investment credentials and personal integrity. And he would have been running the new thing, but as the chief executive of a fund group, just like, you know, that guy called Bogle all those years ago. And I couldn't, they were going to sell. They finally proposed. I couldn't really get it across. I talked to 2 or 3 of the directors. I know firsthand that one of the other directors, with whom I did not speak, tried to persuade him to go this route, to mutualize, because it would have saved this company, I believe, from death.
Could I just ask a little bit more about...
Let me follow up on 1 second.
Yeah,
so they decided to sell it to something called Power Shares of Canada for $5 billion. And so I called the chairman. And what was wrong? He didn't return my call. And that's what happened. And so they had their assets, by the way, had gone from fund assets from like $275 billion, say, to about $45 billion. I mean, if I can't make that sale, you know, I guess I know Dale Carnegie or something. Excuse me.
No, I just wanted to ask one last question before we open it up, and that is about the mutual form itself. The mutual form has obviously worked very well for Vanguard, and I think that's in large part because of your own leadership and your own character that you brought to it. But I've also seen mutual forms that are very discouraging in their outcomes.
Absolutely.
So there's mutual savings banks, there's mutual insurance companies that become very sleepy and very insulated from pressure. Shareholders, whatever other pluses or minuses they have, do put pressure on managers to perform to some degree. Especially large shareholders tend to do that. And these days we have more and more activist large shareholders. I've seen mutual boards that are merely sitting in their seats, collecting their fees, and cannot be budged, and are self-interested. I made a presentation once to a mutual savings fund board that was, or savings bank board that was very discouraging. We had lunch afterwards, and one of the directors turned to me and said, well, this is a very interesting proposal, but what I don't understand is what's in it for me. I thought, man, how would the world ever,
America.
How would the world ever get rid of
Is this
you?
a great country or what?
How would the world ever get rid of you without shareholders?
Yeah. Well, first of all, at least in our structure, the shareholders have a theoretical, and I want to emphasize that. I mean, I can't really disagree with your question. They have a theoretical right. I mean, they are shareholders in corporations, and they get votes. And is that going to work very well when I think Vanguard has 20 million shareholders? I think if there were some extreme proposal put before shareholders, let's say to demutualize, I think the shareholders would rise up and refuse to let it happen. I think at that level they would act. But can they pick off a director? I don't think that's possible, so I agree with you. And I've looked and written a lot critically about the life insurance business when, it wasn't so many years ago, when I looked at the 5 largest mutual life insurance companies, and they were like, I don't know, 25 times as big as little Vanguard was. And we were starting to grow a lot then. And I looked at them 10 years later or 15 years later, and Vanguard was bigger than all 5 of them put together. I mean, it's just amazing in terms of assets. And but the fact of the matter is, and then they of course all went public, and they all went public so they would have capital to make acquisitions. And of course they were right, except they ended up getting acquired rather than being the acquirer. They were the creatively destroyed rather than the creative destroyers in Schumpeterian terms. So and it's also true that I think pretty clearly that before they went public, long before they went public, they'd ceased to be mutual other than in name. In other words, they abandoned mutuality as a concept before they abandoned mutuality as a structure. And I was a director of a great big mutual savings bank in Philadelphia, and I could see it happening right before my mind. They finally went public too. It got worse after they went public, because then they got to be interested in earnings per share and all that kind of thing, like these companies are today. I mean, you see what's going on in the insurance business. And of course, they sold these contracts guaranteeing, irrespective of what the stock market does, guaranteeing your principal. And I guess some of them are going to just end up going. I mean, they're very unwise in what they've done. But, you know, I guess I'd say this. I think if I can make it work, anybody can make it work.
I hope that's true.
But I totally respect and in many, many ways agree with your implicit criticism.